What is going on, ladies and gentlemen? We are back with another video. Today I'm going to be going over the inversion fair value gap, how to trade it, and how to spot it, and the signature and price I'm looking for to actually trade the model. Now, I'm not going to be going over everything regarding the inversion fair value gap. I'm just going to be going over the basics. And yeah, so if you don't know how to trade this, again, this is going to be my official updated video on the inversion fair value gap. So I would strongly suggest watching the rest of this video. And I think that's about it. If you want to watch my live streams every single day, I live trade from about 9:30 Eastern to 11 Eastern. Just click the link in the bio, the WAP link. I'm running a 50% off per month until January 2nd. So if you want to watch me live teach this, not in hindsight, then join that link. And then the other thing is Apex 71% off sale. The 1-day eval thing ends today, I think. Yeah, today. So make sure to get yourself a few accounts and yeah, get that before it ends. So let's get started into this video. So I'm going to link a PDF of like the model I'm actually looking for. Okay. And I have it written down. Okay. I'm going to show you guys what it looks like here real quick. So this right here is the model I'm actually like looking for. Okay. So take a moment, pause the video. This is what I'm looking for. And the thing that I'm going to point out about this is this dotted line. I do not prefer longing this retrace, the dotted line, because, well, you're probably wondering why. I prefer longing the black line because let's say my bias is bearish here, or let's say the bias in general is bearish. If I long this dotted line retrace, this is probably not going to work because the bias is bearish. And if the bias is bearish, we're usually going to take out some internal high and then go down. If we know the market moves from internal liquidity to external liquidity, and we know the bias is bearish, well, when we know once this internal liquidity hits, markets can go for external, which is the low. Now, if we know the bias is bearish, yet we have not hit this internal liquidity, there's a much better shot of this working and for us retracing off of here and going to this high and then going down. So it can still be a winning trade. Now, this is good because what if the bias is bearish, but we think the bias is bullish? Okay, well then if you take this, you're not going to take a loss because we're at least going to hit this internal high, which is usually where I move my stop to break even, or which is usually where I scale half if it's like more than 10 points. Maybe I'll scale like 25%. It just depends on the bias, what I'm thinking. So yeah, pause this video. That's the model I'm actually looking for. So how do I look for inversion fair value gap? The two main things I look for are a liquidity sweep first. All right. And then I look for a delivery off of a PD rate. Okay, so delivery off of FEG, let's say. Now, you're probably wondering, like, what is actually an inversion fair value gap? Why do I like these so much? The reason why I like these so much is because imagine let me just show you guys real quick. All right. Let me show you guys something. Imagine you're learning the 2022 model and it's your first ever time taking it, and you're like, oh, this inversion model looks really good. I'm gonna short this. Right? Let's say right here, for example, you think this is a market structure shift, whatever, blah blah. Okay, and you're gonna short this, and you're gonna, just because of what ICT says, you're gonna think this goes down. Well, what happens? Bang, you get wrecked. See what happens? Now, why do I like the 2022 model? Because an inversion fair value gap is more objective, in my opinion. Okay, you can, like, when an inversion forms, it forms as the candle closes above it. So you can see there's an obvious candle close above here. Like, this is not false. This is a real thing. The candle is clearly closing above here. Okay. So this cannot be mistaken for anything. The candle closes above, it does or it doesn't. Now, a market structure shift in a 2022 model can be subjective. Some people might call this the market structure shift. Some people might call this the market structure shift. Okay, I mean, I don't know why you'd call this one the market structure shift, but maybe some people do, and that's why it's subjective. This is factual. You can clearly see if a bearish fair value gap is violated, what happens? Well, we clearly go much higher here, right? When you see a bearish fair value gap violated, this is wrecking so many people, and we usually go to the next high. So I use that logic, and I wait for a fair value gap to break and for us to go to the next high. And I do not think of the market in terms of inversion fair value gaps. I think of the market in terms of liquidity. Have we already ran stop losses? So in this example, we already ran stop losses here. We already ran stop losses here. Why would the market need to reject here? We don't. And that's where I'm thinking, okay, the market doesn't need to reject here. We ran stop losses. We took out stop losses here and here. Why would the market want to reject this when we have stop losses up here? We have 2 sets of equal highs. It doesn't. So I'm not going to blindly long it because that doesn't make sense, but I'll wait for this to break. And then I'm like, okay, well, because we ran stop losses here, because we inversed this like I anticipated, I'm going to long and sell here, whatever it may be. All right, so that's the idea behind an inversion fair value gap. And for an inversion fair value gap to actually get activated, it has to be closed above or below. So bearish fair value gap has to be closed above, and a bullish fair value gap has to be closed below. So an example would be something like this. Okay, here's a bullish fair value gap. It's clearly closed below. This tells us price is going to go lower. Okay, you can see that, but that's not a great example for many reasons. But here, this is an example right here. So this is the first example. Remember what I said. I look for a liquidity sweep or some sort of delivery off of a PD array. Okay, now we're not really delivering from anywhere important here. I mean, I guess you can call this a rejection block, but not really a fair value gap. I prefer if it's a fair value gap. And what you can see here is price very quickly displaces below its low and very quickly displaces back up. Well, how many people do you think shorted this? Because it's a bearish fair value gap and that's all I know how to do. Probably a lot. So what do you think they're doing when price closes back above this candle? Probably reversing the position. So I take that logic and I'm like, okay, well, I'm going to long now, right? And I'm going to maybe sell at this high, and then maybe there's like a higher buy side to the left here if I look over to the left. Okay, you can see there is a higher buy side here and then higher buy side here. So you can see like the logic behind this and why it's actually so good. It's just because we've ran stops here. If we've ran stops very quickly, again, the key is this is very quickly. It's not like some like slow stop run. This is actually fast. It pops right out of you. If we've ran stops here, why would we need to reject this fair value gap? We don't, okay? And that's where the inversion fair value gap comes into play. All right, and that's kind of my first thing I look for. Some sort of liquidity sweep or some sort of model off of a higher time frame fair value gap. Now, this one was, I mean, I guess you can consider this both. This one, the bodies did hold this fair value gap, which is important to note. And we also did sweep this low. Now, this is a 1 minute time frame. Do you see any obvious inversion here? No, you don't. Okay, everything was closed. But if we go to like the 30-second, and keep in mind, this could happen on like the hourly. Okay, just because I'm on the 30-second doesn't mean anything. If you go on the 30-second, do we have a bearish fair value gap? Yes, we do, right here. So if we know we swept this low and we are clearly displacing back up with a lot of speed, right? We know this candle close should bring us back up to this high. See that? Okay, so we know that candle close should bring us up to the high, and that is the fair value gap model. That is the inversion fair value gap model, right? We should not reject this if we already took these lows because the market does not have to go to these lows. We will respect this, just not to the downside. We'll respect it to the upside, meaning if the body close above and it's good price action, the bodies will want to keep holding above and hit the next high. And you can use this to your advantage and take a play off of that. And that's what I do. Okay, and what I'll do is, this is about a 1.35 risk reward. If this is generally more than 10 points, I will scale here. But typically, I'm always looking for some sort of higher time frame target. So this would be like the higher time frame target here. And then here would be an example. Okay, I'm always looking for the high, like to the left of the chart, seeing if there's any more highs, because usually there is. Like in this example, I would maybe scale here and then here. Okay, but what makes this a good model? Well, we swept the low. It's a singular fair value gap. Okay, being a singular fair value gap is key because if there's multiple fair value gaps in a leg, that's just going to mix a lot of you up, right? Look at here, for example. If we inverse this, that does not mean we have to go way up here. What if we inverse this fair value gap but reject this one? So it has to be a singular one because I've seen it before where like we're going to close above one and then we'll end up rejecting like a higher one and then the play's a loss. So I just like to wait to make sure, okay, it's a singular fair value gap I'm taking. It's the only one right there. And that's what I generally look for. So obviously in this example, I mean, this is a pretty singular one, and this one really pops out at you. Okay, there's some that are going to pop out at you, and there's some that's not going to pop out at you. But This one pops right out at you. It's a singular fair value gap. We clearly break you with decent momentum. My stop loss for this play is actually close below. Okay, so my stop loss is a close below the inversion fair value gap. So let's say price closes above and then closes back below. I'll get out. Now, you can put your stop loss at the low, but most of the time we close back below this inversion. We go hit the low anyways. And two, this is just a way worse risk reward. I'd rather be more aggressive here because from backtesting, this is still a fine stop. I mean, you could even put it below this low if you want. Stop loss is tough for inversions. I do a stop loss as, okay, if we close above a candle and then close back below, I get out. It's a more of a manual stop loss. You can do the lower high. So the other day in my Discord, what I kind of showed people in my announcements was I think it was in Dodgy right here. Okay. I said this is an example of an IFG where you can put the stop at the high because the risk reward is still fine. You don't have to put as a close above, but from backtesting, I promise you, most times you see a close back above, we will go hit the high and stop you out anyways. You'll just set the backtest and see what you're comfortable with. So in this example, you can see you can put the stop loss at the high because the risk reward's still there. But in this example, it's just not really worth it to put it to low because the risk reward's way worse. And this should not even get close to this anyways if this is a good play because, again, the bias is bullish. We clearly took a low. We should not come back down here even close to it if the bias is right. So, again, that's the only downside of this strategy. I mean, sometimes stop losses can be a little weird. You can put a hard stop loss and kind of guess. What I do is I just close it if we close below. And I kind of size down a little bit because it allows me to take more risk just in case if I need to. So yeah, that's kind of my main model. I'm just going to go over a few more examples. I only use these during kill zones. You only want to use them during kill zones. You want to use them when it makes sense. Okay, it doesn't make sense to even trade this week because that's why I'm on a demo account all week because it's a bank holiday today. We have holiday all week. Just because of the Christmas time and New Year's. So it's a holiday week, so I'm not really expecting much this week. But last week, like, we got some really good ones. So last week, end of day, okay, we swept a very major high end of day, or very major low, excuse me. All right, we swept the 830 low, which is also a great liquidity pool. And when we swept this equal low, look what happened. We swept it with speed and displacement. We get a large momentum candle back up, and then here's your inversion. So what I do is, again, I market buy right here, okay, and I'm looking for us to kind of blast above the next internal liquidity, which I would say these are relative equal highs, and then I kind of move my stop to break even after that. Because, again, if you see a candle blasting through 3 equal highs here, okay, you should not expect price to come back down. So I would move my stop to break even there. Maybe scale some if it's 10 points. In this situation, probably not. I would probably hold the next internal high. And again, this is a great liquidity pool. It's a high inside of a fair value gap. And that's where I'm holding to. Now, you could enter just off this bullish fair value gap. But the inversion just makes me so much more confident because it tells me price is probably going to accelerate. Meanwhile, sometimes what happens without an inversion is price dances around in here and takes really long to play out, and I don't like that. So in this example, you can clearly see we have a bearish fair value gap. It's broken. All these guys shorting here, reversing the position, right? We're in good hands here. And yeah, you can clearly see this play just works out really nicely. So that was one example. Another clear example would be right here. Okay, we had a bearish fair value gap here. You're probably going to get a lot of people shorting here. Price holds a fair value gap to the left. This is important too. This is what I mean by delivering off of. Okay, price clearly holds a fair value gap to the left. This is more hindsight. I'm not long in this, but when I see this activated, this inversion broken, and I see, okay, price holds this fair value gap to the left, and we swept this low and barely displaced under it, right? That's just a bullish signature in price. So I know now that this inversion is probably going to work. And again, I'll put my stop, I'll guesstimate it, so maybe around here. And then I'll go for some sort of higher time frame target, which was probably around here if I had to guess. I'm not going to go back, but you can see that's what I do. The only other thing you're probably wondering is, do I enter at the close or do I wait for a pullback? Usually, I will just enter at the close if the risk reward is fine. I feel like the risk reward isn't bad here. think there's a target up here or something like that. But if the risk reward is terrible, I will just wait for the retrace. You will not get the retrace sometimes, and that's okay. If we go to actually gold, I'll show you guys an example. I call this on the gold hourly a couple of days ago. We had an inversion here, and look how bad this risk reward is to the high. If you enter the candle close, if you enter this candle close, it would be 0.9. So in this situation, so here's buy side obviously. In this situation, I would wait for a retrace, but I would accept that maybe I won't get it. So that is it. Excuse my cough there. That's gonna be it for this video. Let me know if you have any questions. Again, I could make this video way longer. I am in the process of making like a full-on inversions course with other content like MMXM, everything else like that, and that's gonna probably be out in a week or two, probably less than 2 weeks if I had to guess. Obviously that's gonna be paid, but I'm still gonna upload videos for free, but it's just not gonna be as much content as you can get in the course, obviously. And this is definitely much more not as organized as the course is gonna be, but the course is gonna be coming out soon. Excuse my cough again. And yeah, there's just so much more I could go over in inversions for value gaps. Some of it's just common sense. Like, would you long a bearish for value gap way up at the high? Probably not. Would you long a bearish for value gap if we hit buy side? Probably not. Like, there's so much more I could put into this that I'm all putting into my course. But I mean, that course is just gonna be the only thing you need once it does come out, and it's not gonna be. People have said, "Oh, you can put that at $500." I'm not gonna do that. I'll probably make it like $229 or something like that. But yeah, so expect that to come out. Obviously I'll update you guys in a video about when that comes out, but that's really gonna be the only thing you need. It's gonna be decent amount of videos, and it's about 200 Google slides, 200 slides of notes that I have, so it's gonna be a lot. But yeah, again, you can see inversions are just so powerful. Like even this one, you can just see how well they work. Obviously this isn't one I would take, but it's one that maybe I'll look for a lower time frame setup on here because we did hit the internal high. But you can just go back in the charts, and I swear there's so many. Like you can just see what happens when we dump through a bearish for value gap, or what happens when we dump through a bullish for value gap. Look how much further price goes, and see how we just speed up right away. That's why I love inversions. They're so useful, and they cause price to speed up so much. Even this one, right? As soon as we close below this one, boom, speeds right down, right? Your play here you wouldn't get a retrace here. Your play here would probably be almost the 1.5, so 1.25 to this low. And again, remember this model. This is really what I look for. Okay, if you go into my Discord, if you guys join my Discord, this is free. Link in bio. Again, this is the model, not this one, sorry. This is the model I'm really looking for. So study this. I post a lot of examples on my Twitter every Saturday. I post like 5 of the best inversions. And again, this is how I trade it. And again, sometimes there will be weeks where it will suck and you will get stopped at break even on a plays after scaling half or whatever it may be. For example, let's say you take this inversion here. Okay, let's say you short it, whatever. Let's say you scale half here, but there's a higher time frame target here. You got to remember, when I'm scaling half at some sort of liquidity pool, I'm moving my stop to break even. And today happens to be a week where after I scale half, price comes back up and then we go down. And that's just how it is on a week like this week, because there's not a lot of volume. There's not a lot of expansion one way. So that's just going to happen sometimes. Other weeks, it'll be great. Other weeks, you'll get plays like this. Let me see if I can find one. Other weeks you'll get plays where we just accelerate right down, and yeah, you're set. But it's just gonna be tough some weeks. Other weeks it's gonna be nice. But again, moving that stop to break even after taking some internal high, it saves you so much. Even in this example right here, we close above this, price hits the internal high. Maybe you scale half. And then you can just see your price ends up dumping all the way down here. So if you put your stop to break even if you didn't scale half, maybe you didn't think the risk reward was good on this, and maybe it's not. Maybe you want to hold till here, but you should still be moving your stop to break even here, because you're going to see once price comes back down to the entry, we just dump way further. So again, that's kind of where I'm at with inversions at the moment. Again, I'm making a much more advanced course on so many more examples on which ones I like the best, which ones I don't like, whatever, blah, blah. There's literally everything you need to know. So stay tuned for that. If you made it to the end of this video, comment water. Again, I'm not sure. A lot of people probably won't make it to the end anyways. And yeah, I think that's going to be it. Let me know if you guys have any questions. And other than that, I'll see you guys later. Peace.